All right, so let's dive into something I'm sure is on a lot of minds these days.
Yeah.
Investing.
Yeah. For sure.
Specifically, we're going to unpack this Motley Fool article
Okay.
from January 8th, 2025, called Where to Invest $100,000 in 2025.
Right.
Think of this as your roadmap, for navigating the market this year, whether you're already a seasoned investor or just starting out.
Yeah, and I think it's important to know that we're not just talking about like what to invest in,
Right.
but the why behind it so you can apply these strategies with confidence.
Exactly. So first things first, the article paints a picture of a market that's been on a tear, especially the S&P 500. It's been in a bull market for a year now and actually surged 23% in 2024 alone.
Yeah, that's right. And that signals a strong market,
Yeah.
But it's a double-edged sword.
Oh, how so?
Well, higher valuations mean we need to be even more discerning about where we put our money.
Okay.
It's not just about riding the wave. It's about finding those undervalued opportunities that others might be missing.
That makes sense. The article mentions lower interest rates and AI as major drivers of this growth.
Yeah.
But what's fascinating is that the article doesn't just stop at AI is hot, invest in it.
Right.
It goes deeper, suggesting we allocate about $20,000 to specific tech stocks, particularly those heavily involved in AI.
Yeah, it's about being strategic, not just chasing buzzwords.
Right.
Like, for instance, Nvidia is mentioned as a key player.
Yep.
They're the leading manufacturer of those powerful AI chips, the brains behind all this machine learning and processing power.
Okay, so it's like investing in the picks and shovels during a gold rush.
Exactly.
Everyone needs those chips.
Exactly. The article also highlights Amazon and Meta Platforms both leveraging AI in unique ways. Amazon uses it to streamline its massive e-commerce operations and enhance those recommendations that seem to know us better than we know ourselves.
And Meta, of course, is incorporating AI across its social media platforms.
Yeah.
From content moderation to targeted advertising.
They're everywhere.
It really is. But here's where it gets interesting. Even with all this talk about AI's potential, the article stresses that we can't forget about a fundamental principle of investing diversification.
Right. Because even the most promising sectors can experience volatility.
Right. That's where this idea of an S&P 500 index fund comes in.
Yeah.
The article recommends putting $20,000 into one, specifically the Vanguard S&P 500 ETF, VOO. But honestly, a lot of people already know about index funds.
Yeah.
What's a nugget of wisdom that the average investor might be missing?
Well, one often overlooked aspect is the tax efficiency of index funds.
Okay.
Because they're passively managed, they tend to have lower turnover rates, which can translate to fewer taxable events compared to actively managed funds.
Okay, that's helpful, especially for someone trying to minimize their tax burden.
Absolutely. And remember, historical data shows the S&P 500 delivering an average annual return of over 10%.
Right.
While past performance isn't a guarantee of future returns, it gives us an idea of its potential. Plus, with index funds, you're not betting on individual companies. You're essentially betting on the overall growth of the market.
Speaking of diversification, the Motley Fool suggests we take another $20,000 and venture into the world of individual stocks and ETFs spanning various industries and investment styles.
Right.
This is where things get a bit more tailored to individual preferences, right?
Exactly.
Yeah.
This is where you can align your investments with your own interests and beliefs. Maybe you're passionate about renewable energy or see potential in the future of healthcare.
Yeah.
This is where you can really dive deep into specific sectors.
I see. So with individual stocks, you're taking a more targeted approach, but with higher risk.
Yeah.
Compared to the broader net you cast with an index fund.
Exactly. And when it comes to investment styles, you have options like growth investing, focusing on companies with high growth potential, and value investing, which targets those potentially undervalued companies with solid fundamentals.
Got it.
The article emphasizes the importance of understanding your own risk tolerance and financial goals before diving into this part.
That makes sense. There's no one-size-fits-all approach here.
Right.
It's about finding what aligns best with your own situation and comfort level.
Precisely. And this is also where ETFs can be really useful.
Okay.
They allow you to diversify within a specific theme or sector, providing a sort of middle ground between individual stocks and broad market index funds. Think of it as a more focused approach to diversification.
Okay, I'm starting to get the hang of this.
Good.
We've covered AI-focused tech stocks, a broad market index fund, and now individual stocks and ETFs tailored to specific interests and styles.
Yep.
That's $60,000 of our hypothetical $100,000 allocated.
Okay.
Where do we go from here?
Now let's shift gears to a strategy that many investors find particularly appealing.
Okay.
Especially for generating passive income dividend stocks.
Oh, yes.
The Motley Fool recommends allocating $20,000 to them.
Those stocks that pay you just for holding them?
That's right. And within the world of dividend stocks, the article suggests looking at dividend kings.
Okay.
Companies with a remarkable track record of increasing their dividend payments for at least 50 consecutive years.
Oh.
They're the elite of the dividend world, demonstrating a strong commitment to rewarding their shareholders.
50 years, that's some serious dedication.
It is.
The article mentions Coca-Cola and Johnson & Johnson as prime examples.
Yeah.
Why are they considered such reliable dividend payers?
Well, these companies have well-established brands, global reach, and a long history of weathering various economic storms.
Makes sense.
They prioritize rewarding their shareholders through consistent and, importantly, growing dividends.
So it's not just about getting a dividend. It's about choosing companies that have a proven track record of maintaining and growing those dividends over time.
Exactly.
Makes sense.
And as always, even with dividend kings, diversification is still key.
Right.
Don't put all your dividend eggs in one basket.
All right, we're at $80,000 of our $100,000 allocated. What do we do with that last chunk?
This is where we get to something the article calls an opportunity fund.
Okay.
And it's a strategy I find quite intriguing. It involves setting aside that remaining $20,000 for well opportunities.
Okay, I'm definitely curious about this.
Yeah.
It's like having a financial SWAT team ready to deploy when the perfect target appears.
Exactly.
But how does one actually use an opportunity fund effectively?
It takes a combination of patience, discipline, and a keen eye for market trends.
Okay.
It's about staying informed, conducting thorough research, and being prepared to act decisively when a compelling opportunity presents itself.
So it's about being strategic and selective, like a seasoned sniper waiting for the perfect shot.
Exactly. But before we map out exactly how to use this opportunity fund, there's one crucial step the article emphasizes before we even think about implementing any of this.
The pre-investment checklist.
Yes.
This is where we make sure we're setting ourselves up for success, right?
Exactly.
It's like we're building a house here.
Yeah.
You wouldn't start constructing a skyscraper on shaky ground, would you?
Right.
What's the foundation we need before diving into any of these investment strategies?
You hit the nail on the head. The Motley Fool really stresses having an emergency fund before anything else.
Right, because without that cushion, any unexpected expense could force you to tap into your investments prematurely.
Exactly.
Potentially selling at a loss. It defeats the whole purpose of long-term growth.
Exactly. It's about protecting yourself from those financial curveballs life throws your way.
Right.
An emergency fund provides that much-needed stability and peace of mind.
Okay, so emergency fund checked off the list.
Right.
What other elements should we be considering before mapping out our investment plan?
Well, while the article doesn't go into specifics, there are a few things I always recommend.
Okay.
First, define your financial goals.
Okay.
Are you saving for retirement? A down payment on a house? Or perhaps that dream trip around the world?
It's like setting a destination before starting a journey. You need that clear vision of where you want to go to chart the best course.
Precisely. Next, consider your risk tolerance.
Okay.
How comfortable are you with the ups and downs of the market? Are you seeking aggressive growth? Or do you prefer a more conservative approach?
It's about understanding your own financial personality.
Yeah.
Some people are comfortable with roller coasters. Others prefer a scenic train ride.
Exactly. And of course, we can't forget diversification.
Right.
It's something we touched upon earlier, but it's worth reiterating.
Yeah.
Spreading your investments across different asset classes, sectors, and even geographic regions is crucial for managing risk.
It's about not putting all your eggs in one basket, as the saying goes.
Now, once you have those foundational elements in place, emergency fund, clear goals, and an understanding of your risk tolerance, it's time to craft your investment plan. Let's use the Motley Fool's breakdown as our guide for that hypothetical $100,000.
Okay, let's map it out step by step.
The first $20,000, as we discussed earlier, goes to those tech stocks riding the wave of the AI revolution. Nvidia, Amazon, and Meta Platforms are all solid contenders.
For someone who's new to this, what's the actual process of buying these stocks?
Well, it's easier than you might think. You'll need to open a brokerage account.
Okay.
There are many reputable online brokers available, each with different features and fees.
Got it.
Once you've funded your account, you can easily buy and sell stocks through their platform. Many even offer educational resources to help you get started.
So AI-focused tech stocks, step 1, Done.
Right.
What's next on the agenda?
Step 2 is to allocate another $20,000 to the Vanguard S&P 500 ETF, VOO, providing broad exposure to the U.S. stock market and its potential for long-term growth.
And as we discussed, there's flexibility here.
Right.
You can invest that $20,000 all at once or spread it out over time through regular contributions.
Exactly. It all depends on your financial goals and how you want to approach it. Now, step 3 gets a bit more hands-on.
Okay.
This is where we take another $20,000 and diversify across individual stocks and ETFs, exploring different industries and investment styles.
This is where the real research comes in.
Right? Yes, it requires a bit more due diligence. Think about sectors that genuinely interest you or align with your beliefs.
Okay.
Maybe you're passionate about renewable energy.
Yeah.
Or see potential in healthcare innovations or the future of e-commerce.
It's almost like you're investing in a future you believe in, not just chasing profits.
Exactly. And remember those ETFs we discussed?
Yeah.
This is where they can really shine. They allow you to invest in a basket of companies within a specific theme or sector, offering a more focused approach to diversification.
So far, we've allocated $60,000 of our $100,000.
All right.
What's the next move?
The Motley Fool recommends allocating $20,000 to dividend stocks.
Okay.
Specifically, they highlight those dividend kings like Coca-Cola and Johnson & Johnson companies that have a long history of increasing their dividend payouts year after year.
It's that idea of getting paid just for owning the stock that's so appealing.
Yeah.
But are there risks associated with even these seemingly stable companies?
Of course, no investment is entirely risk-free.
Right.
Even dividend kings can be affected by market downturns or company-specific challenges.
Yeah, that's true.
That's why diversification is crucial, even within your dividend stock portfolio.
Excellent.
Spread your investments across multiple companies and sectors to minimize risk.
Great point. So we're at $80,000 invested.
Okay.
Now we get to that final $20,000, the money earmarked for the opportunity fund.
Right.
I'm still really curious about how this works in practice.
Well, imagine that a stock you've been watching suddenly dips in price for reasons unrelated to its long-term potential.
Okay.
Or perhaps a new company with a groundbreaking product or service goes public.
Right.
That's where your opportunity fund comes in, allowing you to act quickly and capitalize on these unexpected situations.
It's like having that extra gear to give you an edge in the investment game.
But, and this is crucial,
Okay.
the opportunity fund isn't about impulsive decisions.
Right.
It requires patience, discipline, and careful research.
Got it.
Don't chase every fleeting trend or hot tip.
It's about being strategic and selective. Wait for the right moment, then strike with precision.
Now, before I move on to the final part of this deep dive,
Okay.
it's important to remember that this entire investment plan is just a blueprint. It's crucial to tailor it to your individual financial goals, risk tolerance, and time horizon.
Absolutely.
Okay.
What works for one person might not be the right fit for another.
Right.
It's about finding what aligns best with your own circumstances and aspirations. Is there anything else you think our listeners should keep in mind as they embark on this journey?
Yes, remember that the world of investing is constantly evolving. Staying informed and continuously learning is essential.
Right.
Read books, articles, listen to podcasts, follow reputable financial news sources.
Yeah.
And don't hesitate to seek advice from a qualified financial advisor if needed.
It's not about setting it and forgetting it.
Right.
It's about being engaged, adapting, and always seeking to expand your knowledge.
Exactly.
Welcome back to the final part of our deep dive into investing $100,000 in 2025. We've covered a lot of ground, from AI-powered tech stocks
Yeah, we have.
to the stability of dividend kings and even strategic use of an opportunity fund.
Right. It's been quite a journey exploring the market landscape
It has.
and breaking down the Motley Fool's investment plan step by step.
Yeah. So now let's shift gears and distill some key takeaways for our listeners.
Okay.
What are some of the most important insights that have emerged from this deep dive?
Well, one that's been woven throughout our conversation is the absolute importance of diversification.
Absolutely. It's been mentioned in almost every segment.
Right.
And for good reason.
Yeah. It's not just a catchy phrase. It's a fundamental principle for managing risk.
Right.
No matter how tempting it might be to go all in on a single stock or sector.
Yeah.
Spreading your investments across different asset classes, sectors, and even investment styles can significantly reduce your exposure to potential losses.
It's about building that balanced portfolio with a mix of stability and growth potential. Another takeaway that really stood out to me is the rise of AI and its undeniable impact on the investment landscape.
Yeah.
The article highlighted those tremendous growth projections for the AI market, making a strong case for including it in any forward-looking portfolio.
Yeah, we're witnessing a technological revolution.
We really are.
And as investors, we have the opportunity to participate in that transformation.
For sure.
But it's important to approach AI investments with a balanced perspective.
Right.
Thorough research and a long-term mindset are essential.
The article also spent a good amount of time on dividend stocks.
Yeah.
Particularly those dividend kings, as a way to generate passive income and add stability to a portfolio.
Those companies with their impressive track records of consistently increasing their dividends for decades.
Yeah, it's incredible.
Can provide a sense of reliability and a steady stream of cash flow.
Right. But as we discussed even with dividend kings, diversification is still crucial. Don't limit yourself to a single company or sector.
Exactly.
The concept of an opportunity fund also resonated with me.
Yeah.
It's like having that financial reserve ready to deploy when the perfect investment opportunity arises.
It's a strategic approach.
It is.
That requires patience and discipline, staying informed, conducting thorough research, and being able to act decisively are all key elements of using an opportunity fund effectively.
So as we wrap up this deep dive,
yeah,
what are some actionable steps our listeners can take to put all this knowledge into practice?
Well, first, revisit your financial goals and risk tolerance.
Right.
Ensure that your investment strategy aligns with your personal circumstances and aspirations.
Right.
Investing isn't one size fits all.
Nope.
It's about finding what works best for you.
That makes a lot of sense.
Yeah.
And as we've emphasized throughout this deep dive, don't underestimate the power of research.
Exactly. Take the time to thoroughly research potential investments, read articles, analyze financial statements, follow industry trends, and don't hesitate to seek advice from a qualified financial advisor if needed.
Knowledge is power, especially when it comes to managing your money. We've talked a lot about diversification, but it's worth repeating one last time.
It's that important. Don't put all your eggs in one basket.
Right.
Spread your investments across different asset classes, sectors, and investment styles to mitigate risk.
And finally, remember that investing is a long game.
It's a marathon, not a sprint.
Right.
Be patient, stay the course, and don't get discouraged by short-term market fluctuations.
Yeah.
Focus on those long-term goals.
Before we sign off, let's leave our listeners with a question to ponder as they embark on their own investment journey.
Okay.
If you were to invest $100,000 today, where'd you start and why?
That's a great question to reflect on.
It is.
Consider everything we've discussed in this deep dive.
Right.
The current market landscape, the potential of AI, the importance of diversification, the allure of dividend stocks, the strategic use of an opportunity fund, and apply it to your own unique circumstances and financial goals.
And remember, the journey of investing is just as important as the destination.
Absolutely.
Embrace the process, stay curious, and never stop learning.
Well said. There's always something new to discover in the world of finance.
And that's a wrap on our deep dive into investing $100,000 in 2025. We hope you found this exploration informative, insightful, and empowering. Remember, knowledge is power, especially when it comes to your finances. So keep learning, keep exploring, and keep investing in your future. Until next time, happy investing.